All right, traders, let's get into our second interview here. Let's go ahead. Let's bring on Siddharth Singhai, Ironhold Capital Chair, CIO. Welcome to the show.
Well, absolute pleasure to be here, and thanks for inviting me.
Of course, I've definitely I took a little bit of time to watch some of the kind of the business school speakings that you have done in the past, and I gotta say, if you guys get a chance to check those out, definitely go ahead and do so, especially if you're into value investing, right? So first thing I want to know a little bit more about Ironhold Capital. What is the strategy that you guys do? And of course, tell me a little bit more about value investing.
Sure. So we're a global value-based hedge fund. What that really means is that we're looking for asymmetric risk-reward opportunities wherever we can find them. Now, we do focus on US and India as core part of our portfolio, but we have investments in, say, a country like China. So we are really global value investors. And the strategy of value investing is not different than what the version that Mr. Buffett does, which is we identify high quality businesses. We try and buy them for a huge discount to the intrinsic value. And we want those businesses to be run by great management teams. And we're long-term investors. So we're not too concerned about short-term fluctuations in the market. And if it takes a couple of years for the stock to realize its gains or achieve fair value, then we're more than happy to hold it for that duration. And we're relatively concentrated. We have about 12 to 14 positions typically. That's the high level strategy.
So let's talk a little bit about why only a long-term approach seems to make sense when you're taking a look at a strategy like this.
Sure. So value investing is built on the belief that the market is irrational in the short run. And frankly, it's random. So what we believe is that it's not predictable in the short run, and that it's, very few people, if you look at the history of the stock market, have been able to successfully trade short term and, do it consistently over a long period of time. But over the long run, the value of a business and its market value, or what it's trading for on any stock market or exchange, they seem to coincide. And that is where we book our gain. So if we get into any business, we don't know what the stock's going to do a month from now, 2, 3 months from now. But let's say if we are able to buy it for 50 and we think it's worth 100 and we're buying it for 50, and it takes a couple of years for that gap to close, then, we can get some really good returns out of that. And so it's really the belief that you cannot predict the markets in the short run, which is why we choose to be long term.
Next question I have about is, how should investors approach a market environment like we're in right now? I mean, it's definitely a tough one out there. How would you approach it, Sid?
Sure. So I think this is a difficult environment. I think the priority should be capital preservation. And I think the one thing investors can do is look at high quality businesses that exist out there. They're like tennis balls. So they might go through a recession and they'll bounce back up. In fact, not only do they bounce back, but they come back even stronger because they're able to take market share away from lesser able or less efficient competitors. So, really be in high quality businesses, pay a good price for them. I think that still works.
Definitely. Now, of course, you do more research into, of course, fundamentals than probably a lot of the retail traders out there. So what are some good indications that a company is trading at a good discount? Should we look at price to forward earnings? Should we look at book value? What are some of the things that we should be watching in the fundamentals?
Well, I think both of those could be good indicators. Now, we typically look at yield, or which is the inverse of PE. So PE is a good place to begin. I would look for high return on equity over a long period of time. I would also look for a very strong balance sheet. And, from that, we get a universe of stocks. And then after that, I think it is up to the investor to decide where he shall play. So if somebody understands pharmaceutical companies really well, I think from that universe, they can look at pharmaceutical companies. And I think you should take it on a case by case basis rather than a sectoral basis. So, that's how I would go about it.
Now, I've been looking to see if there's any industries that are starting to get at a good, value investing outlook. Is there any area or theme that you're looking at that's finally getting to the point where the valuations are kind of making sense?
Sure. So I think tech right now is extraordinarily cheap. And this is across big tech, or you could look at the FANGs, or you could look at the smaller size companies within tech. Now, I think there's a challenge in identifying the money losing technology companies that didn't deserve the valuations to begin with, and now they've corrected. But on the other hand, you also have companies that are or were incredible, but they've been beaten down unnecessarily because money's just flowed out of tech. So, a company like Wix.com, for example, it's been beaten down. It's down 70% year to date. And if you look at the fundamentals, it's an extraordinary company. There was no obvious reason why that would happen. So tech, I would say, is where people should be really looking for profitable companies with a good track record.
Excellent. Now I have to ask the hard question, at least from your opinion, what do you see coming? Do you see recession in the US coming right now? How do you see it?
Well, I think the recession would be very tough to call because the economy, we already had somewhat of a recession during COVID. And, we had very high unemployment, and we had a whole bunch of businesses that could not sustain themselves and hence needed government intervention. So it is really, you could look at spending, consumer spending, you could look at, there's nothing fundamentally weak about the economy yet. Now, of course, if the interest rates go up quite a bit, then there's going to be somewhat of a slowdown. But I don't see a huge recession in the economy as much as I see a big correction in the market. I think those two things are slightly different. So you could maybe not have a recession, but the stock market could still decline, which I think is a very high probability scenario, given that it's still, even after the correction this year, very overvalued. I still think that at least 10, 15% above where it should be. So I think you may have a slowdown. I won't really call it a recession, but the market could really get beaten up over the next 6 months.
Definitely, I think you're right there. I mean, doesn't necessarily mean recession right now, especially the way that we're seeing the job market. Job market doesn't point to recession, but a correction. Like you said, we did get a lot of helping in a certain time when it was a really tough time. Could see that correction come down. Thank you for joining me today, guys. This is the Iron Capital Chair, CIO Siddharth Singhai. Thank you for joining me, and I'm willing to have you back on. I want to talk a little bit more about value investing. Maybe we do a little bit more deeper dive in kind of like looking into earning sheets, because I feel a lot of times, especially retail out there, just doesn't know what to look for. And so maybe we'll work on that. Appreciate you coming on.
Well, absolute pleasure. Thank you for inviting me.